For today's presentation, I will be covering the Heartland case. My name is Sarah Barcelo, and without further ado, let's get right into it. I want to begin by looking at the case background. So this case centers around Heartland's payment systems, a significant player in credit card servicing industry, which experienced a severe data breach during the fiscal year 2008. This breach, perpetrated by international hackers, compromised the operational data of the company, including credit and debit card information of its customers. The breach, discovered in 2009 of January, raised immediate concerns for Heartland's financial availability and triggered a series of responses from the company, its external auditors, and legal entities. The breach not only necessitated an assessment of its immediate and long-term financial impacts, but also prompted ethical considerations regarding accountability of financial statement preparers and auditors in the emerging realm of cybersecurity. Despite Heartland's efforts to manage the fallout from the breach, including legal disputes with shareholders and credit card processors, significant uncertainties loomed over its future as a going concern. The company's stock price plummeted, and it faced potential liabilities that could deplete its cash reserve and jeopardize its ability to continue operations. The audit team faced challenges in evaluating the financial repercussions of the breach, given the lack of comparable precedents and uncertainty surrounding the extent of potential legal liabilities. This case underscores the intricate interplay between cybersecurity, financial reporting, and ethical considerations, highlighting the complex challenges faced by companies and auditors in navigating such a crisis. So, over the course of this presentation, I will be covering my responses to the case assignment questions 1 through 9. I've categorized them into 3 categories. We have the first 3 questions, which are just general questions about the case study. The second category is questions 4 through 6, which addresses legal liabilities. And our third category, questions 7 through 9, is going through the ongoing concerns. So let's dive into our first question, which is the announcement of the data breach a recognized subsequent event? So the announcement of the data breach would be considered a recognized subsequent event according to the Financial Accounting Standards Board and the Accounting Standards Codification, topic 855, which is titled Subsequent Events, an event that occurs after the balance sheet date, but before the financial statements are issued or available to be issued, is a subsequent event if it provides additional information about conditions that existed at the balance sheet date. In the case of Heartland Payment Systems, the data breach occurred after the balance sheet date, but provided significant information about the security and integrity of the company's operations, which would have been relevant to the users of the financial statement. So in response to the data breach announcement, management is responsible for evaluating the implications of the breach on the financial statement. So in that topic 855, it outlines that management's responsibility to evaluate subsequent events up to the date that the financial statements are issued. Management should assess the impact of the breach on the financial statement, including any potential liabilities, losses, or changes in the company's financial position. Additionally, management should ensure that the appropriate disclosures are made in the financial statement regarding the breach and its potential effects. On the other hand, the auditor's responsibility is governed by auditing standards, such as those established by the Public Company Accounting Oversight Board or the American Institute of Certified Public Accountants. For easy's sake, I'm going to use their abbreviations just so I don't have to say those every time. So according to the PCAOB auditing standard number 5601, which is also titled Subsequent Events, the auditor has a responsibility to perform procedures to identify subsequent events that require adjustments of or disclosure in the financial statements. This includes evaluating the impact of the data breach on the financial statements and determining if any adjustments or disclosures are necessary. The auditor should also consider the implications of the breach on the company's ability to continue as a going concern, as outlined in the PCAOB Auditing Standard 5705, which is titled The Auditor's Consideration of an Entity's Ability to Continue as a Going Concern. Overall, the auditor's responsibility include assessing the effects of the data breach on the financial statements and ensuring that the appropriate disclosures are made to the users of the financial statement. So let's move on to our second question. And that is, do you believe that the data breach provides evidence of a significant deficiency in the company's internal controls over effectiveness of operations? So let's jump right into this. I believe that the data breach in the Heartland systems likely indicates a significant deficiency in the company's internal controls over the effectiveness of the operations, particularly in the realm of cybersecurity and protection of sensitive information. So the COSO, that is the Committee of Sponsoring Organizations of the Treadway Commission, framework defines internal controls as a process designed to provide reasonable assurance regarding the achievement of objectives in operational effectiveness, efficiency, and reliability of financial reporting. The breach suggests that Heartland's internal controls relating to data security and protection were inadequate, as evidenced by the unauthorized access to sensitive customer information. So, one way I wanted to answer this question was looking at this from an auditor's perspective, looking at what the auditor's responsibilities are regarding the assessment of an internal control effectiveness, what sort of test could they run for further evidence of the conclusion I came to. Obviously, I don't have the company on hand, I can't run these tests, but if I did, these are some things I think would be helpful to do to ensure effectiveness in the internal controls. So number one, we have I think we should evaluate the design and implementation of Heartland's internal controls related to security regarding access controls, encryption methods, monitoring procedures, and incident response protocols. Test the operating effectiveness of internal controls to assessing whether they were functioning as designed. This may involve performing test controls such as reviewing access logs, analyzing security configurations, and conducting vulnerability assessments. Also, assess the adequacy of management's response to prior known weaknesses or vulnerabilities in the internal control environment, as well as any remediation efforts implemented following previous audits or assessments. Lastly, to review any reports or finding from independent third-party assessments of Heartland's cybersecurity measures, such as security audits or compliance assessments against industry standards. So I think all these tests would contribute to the auditor's overall assessment of the internal control effectiveness and would help identify areas for improvement to prevent any further incidents. So our next question is a little similar to this one, except we're addressing financial reporting. So, do you believe the data breach provides evidence of significant deficiency in the company's internal controls over financial reporting? So, the data breach in Heartland's system likely indicates a significant deficiency in the company's internal controls over financial reporting. Again, according to the COSO framework, internal controls over financial reporting aim to provide responsible assurance regarding the reliability of financial reporting and preparation of the financial statements in accordance with applicable accounting standards. The unauthorized access to sensitive customer data includes credit and debit card information, suggests weakness in the company's internal controls over the protection and integrity of the financial information. And just thinking of this from an auditor's perspective, it's just such a big burden that they need to make sure their security is good because they are handling people's debit and credit card information, but also for their own company's sake, they need to have this cybersecurity. So again, taking the same approach as the last question, what are some tests that we could run to ensure the safety, or in this case, where we want to help identify areas to improve and mitigate risk of financial misstatement or fraud. So, what test could an auditor perform? Again, I think that would be evaluate the design and implementation of Heartland's internal controls, in this case over financial reporting, focusing on controls related to the safeguarding of financial data, accuracy of financial transaction, and completeness and accuracy of financial reporting. Test the operating effectiveness of these internal controls to assessing whether they were functioning as intended. These may involve performing a substantive test of transaction and balances, doing reconciliations such as journal entry testing and account reconciliations. So, assessing the adequacy of management's monitoring activities and oversight of internal controls over the financial reporting, including the effectiveness of internal audit functions and any findings or recommendations from previous audits. Review any reports or findings from independent or third-party assessments or regulatory examination related to the effectiveness of internal controls over financial reporting. So I think all of this would contribute to the auditor's overall assessment of the internal controls and effectiveness. And this test, I believe, would help identify the areas that we need to improve to mitigate any risk of financial misstatements or fraud. So looking on to our fourth question, it is, do you believe that the shareholders' lawsuit has met all the conditions for suing the company and its management? And could it result in a financial loss for Heartland? Why or why not? The conditions for the shareholders to file a lawsuit against the company and its management are typically outlined in the Exchange Act of 1934, specifically Section 10B of the Securities Exchange Act. Rule 10b-5 promulgated thereunder prohibit fraudulent activities in connection with the purchase or sale of securities. Shareholders may bring a lawsuit if they believe that the company or its management made material misstatement or omission of fact regarding the company's financial condition, operating, or prospects, and these misstatements or omissions cause the shareholders to suffer financial loss. Looking at this from the perspective of the case of Heartland Payment Systems, shareholders filed a class action lawsuit alleging that the company and its management knew about the data breach as early as May of 2008, but failed to disclose the information to the public. If the shareholders can prove that Heartland and its management knowingly withheld material information about the data breach, and that this omission caused the shareholders to suffer financial loss meaning a decline in the value of their shares, then the lawsuit may meet the conditions for suing the company and its management. Whether the lawsuit could result in a financial loss for Heartland truly depends on the outcome of the litigation. If the court rules in favor of the shareholders and determines that Heartland and its management violated security laws by failing to disclose material information about the data breach, Heartland could be liable for damages. These damages could include compensatory damages to reimburse shareholders of their financial losses, as well as potential punitive damages for if the court determines that Heartland's actions were particularly androgynous. Therefore, depending on the outcome of the lawsuit, Heartland may face financial loss as a result of the shareholder litigation. Moving on to another question about legal liability is question number 5. Do you agree with Heartland's decision that a loss contingency should not be accrued in the financial statements? Okay, so Heartland's decision not to accrue a loss contingency related to the data breach in the financial statement is reasonable given the uncertainty surrounding the potential liability stemming from the breach. According to the relevant accounting standards, specifically the Accounting Standards Codification, topic 450, which is titled Contingencies, a loss contingency should be accrued in the financial statement if both probable and reasonably estimable. In this case, the extent of financial impact from the data breach, including potential liabilities for reimbursement of credit card networks, fines from regulatory bodies, and legal expenses, was uncertain at the time of the financial statement preparation. So looking further at the Accounting Standards Codification, 450, it states that estimated loss from a loss of contingency shall be accrued by a charge and income if both the following conditions are met. One is information liability had been incurred at the date of the financial statement, and 2, the amount of the loss can be reasonably estimated since the exact amount of liabilities resulting from the data breach was uncertain and could not be reasonably estimated at the time of the financial statement preparation. Heartland appropriately decided not to accrue a loss contingency. However, while a loss of contingency may not have been accrued, Heartland should have provided appropriate disclosures regarding the data breach in the footnotes to the financial statement. And that would be required under this codification 450, which outlines the disclosures requirements for loss contingency. Heartland should have disclosed the nature of the contingency, including the events leading up to the breach, the potential financial impact, and any other relevant information would assist users of the financial statement in understanding the nature and extent of the contingency. So, kind of my conclusion of that is while Heartland's decision not to accrue the loss of contingency in the financial statements is supported by the accounting standards due to the uncertainty surrounding the potential liabilities, appropriate disclosures should have been provided to ensure transparency and inform stakeholders about the situation. Let's move on to question number 6, which states, do you believe that Heartland's disclosure of the data breach meets this standard? Why or why not? So, question number 6, to evaluate whether Heartland's disclosure of the data breach meets the SEC requirement to elicit disclosure of timely, comprehensive, and accurate information about risk in and events that a reasonable investor would consider important to an investment decision is essential to analyze both the Form 8K dated January 20th of 2009, and pages 4 through 5 of Heartland's 2008 10K filed on the 3rd 1609. So the Form 8K provides timely disclosures of the data breach, as it filed promptly on January 20th of 2009, shortly after the breach was disclosed. It includes essential information such as the nature of the breach, the potential impact on the company, and the actions taken in response to the breach. This form serves as an alert to the investors to the significant event and allows them to consider its implications for their investment decision. Similarly, pages 4 through 5 of Heartland's 2008 10K filing provide comprehensive information about the data breach, detailing the timeline of events, the company's response, and the potential consequences. The filing acknowledges the security breach and potential financial and repercussional risk associated with it. By including this information in the annual report, Heartland ensures that the investors have access to a thorough understanding of the situation and its potential impact on the company. Overall, both the Form 8K and 10K filing meet the SEC requirement for disclosure of timely, comprehensive, and accurate information about significant events. They provide the investors with information necessary to assess the risk and make informed investment decisions. However, it's essential to consider the specific content of these disclosures in light of investors' perspectives and the materiality of the data breach to the company's financial condition and operations. Moving on to question number 7. What is your opinion regarding Heartland will exist throughout 2009? So, predicting whether Heartland will exist throughout 2009 requires a comprehensive analysis of the factors influencing its financial availability, going concern status. While the case presents several arguments, both for and against Heartland's continued existence, some uncertainties and risk warrant careful consideration. So, on one hand, Heartland faces significant challenges stemming from the data breach and its potential financial and repercussions. The breach exposed vulnerabilities in Heartland's cybersecurity measures, leading to concerns about its ability to safehold sensitive customer information and maintain the trust with merchants and consumers. Additionally, the potential legal liability associated with the breach, including lawsuits from shareholders and credit card companies, pose substantial financial risk to Heartland's operations. The decline in Heartland's stock price and the increase in trading value following the breach indicate heightened investor scrutiny and concerns about the company's future prospects. On the other hand, Heartland has taken steps to address the aftermath of the data breach and mitigate its impact on the company. It has cooperated with law enforcement agencies, implemented remedial measures to enhance its cybersecurity defenses, and reassured merchants of its commitment to data security. Furthermore, Heartland's ongoing operations, customer relationships, and efforts to maintain compliance with industry standards may contribute to its reliance amidst the challenges it faced. However, despite these efforts, the uncertainty surrounding the extent of the data breach, potential legal liabilities, and the company's ability to recognize investor confidence remain significant. Without a clear understanding of the full financial operating implications of its breach, it's difficult to assess Heartland's prospect of survival throughout 2009 with certainty. So, in conclusion to that question, while Heartland's efforts to address the data breach and reassure stakeholders are commendable, and the uncertainties and risk associated with the breach and its aftermath cast doubt on the company's ability to exist throughout 2009. I think investors should closely monitor development and seek additional information to make informed decisions on their investments in Heartland. I think, that would be my answer as an auditor, but me personally, I don't know. I wouldn't trust the company very much. Let's move on to question number 8, which states, do the company and or the auditor have an ethical responsibility to preeminently disclose potential issues when determining whether the company will exist as a going concern? Why or why not? Both the company and the auditor have ethical responsibilities regarding the preemptive disclosure of potential issues when determining whether the company will exist as a going concern. Ethical principles dictate that both parties should prioritize transparency and act in the best interest of the stakeholders, including investors and creditors. From the company's perspective, there is an ethical obligation to disclose potential issues that could affect its ability to continue operating as a going concern. This includes providing timely and accurate information about significant risks, uncertainties, and events that may impact the company's financial availability. Failure to disclose such information could mislead investors and creditors, leading to uninformed investment decisions and potential financial harm. Similarly, auditors have an ethical responsibility to assess the company's going concern status objectively and report any concerns to stakeholders. This includes evaluating the company's ability to continue operating for the foreseeable future and considering any indicators of financial distress or uncertainty. If the auditor identifies significant doubts about the company's ability to continue as a going concern, they must disclose these in their audit report and communicate them to the shareholders and other stakeholders. Failing to do so would undermine the integrity of the audit process and could erode trust of financial reporting. Overall, both company and auditor have ethical obligation to preemptively disclose potential issues related to the company's ongoing concern status. By prioritizing transparency and accountability, they can uphold ethical standards and promote trust and confidence in the financial markets. Our last question is number 9, which states, there has been a debate in recent years regarding whether the company or the audit is the best position to evaluate the company's going concern status. Which party do you believe will provide the best viewpoint for investors? This is such an interesting question. So, the debate regarding whether the company or the auditor's best position to evaluate the company's ongoing status revolves around their respective roles, access to the information, and potential biases. Ultimately, both parties play a critical role in providing valuable insight to investors, but each have a different perspective. The company as the entity responsible for its operation and financial management possesses firsthand knowledge of its current financial condition, strategic plans, and potential risk and uncertainties. Therefore, the company has a more intimate understanding of its internal workings and may be better positioned to assess its short-term and long-term viability. However, the company has incentives to downplay or conceal negative information to maintain investor confidence and protect their reputation, potential leading to bias assessment. On the other hand, auditors bring independence, objectivity, and professional enterprise to the evaluation process. They are required to conduct a thorough examination of the company's financial statement, internal controls, and other relevant factors applying to the audit standards and professional judgment. Auditors may uncover red flags or indicator of financial distress that the company's management overlooks or tries to downplay. However, auditors rely on the information provided by the company and may not have access to all relevant internal information. In terms of providing the best point of view for an investor, a combination of both perspectives from the company and the auditor is likely ideal. Investors can benefit from the company's insight into its operations and strategic innovative, as well as the auditor's independent assessment of the company's financial statements and internal controls. By considering both viewpoints, the investor can gain a more comprehensive understanding of the company's going concern. So if I had to pick one of the two, although I think the ideal standpoint, as I stated, would be to have both the company and the auditor's perspective, I would like to point out that the best perspective, if you must choose one, would be from the auditor's perspective, because it's a third party. They're not biased. Their main limitation is based off of what the company provides to them. So ultimately, transparency, disclosure, and effective communication between the company and auditors and investors are essential for ensuring investors have access to reliable information for evaluating the company's ongoing concern status. So I wanted to wrap up this presentation with some key takeaways, and I have broken those down into the importance of cybersecurity, responsibility of management and auditors, evaluation of internal controls, legal and financial implication, transparency and disclosures, and lastly, ongoing concern assessments. So, Heartland, the key takeaways from this case of Heartland Payment Systems and its cybersecurity impact on audits and financial statement contingencies. This is what I broken them down into. So, looking at the importance of cybersecurity, the case highlights the critical importance and robust cybersecurity measures for companies, especially those handling sensitive customer data. A data breach can have a severe financial and repercussional consequence, affecting not only the company's operations, but its relationship with the stakeholders. Responsibilities of management and auditors. Both management and auditors have responsibility in assessing and addressing the impact of significant events such as data breaches. Management must promptly disclose material event and risk to investors, while the auditors must independently evaluate the implications for financial reporting and communicate any concerns with the stakeholders. Evaluation of internal controls. The case prompts consideration of effectiveness of a company's internal controls, particularly in safeguarding against cybersecurity threats. Auditors must assess whether internal controls are adequate to prevent, detect, and respond to such risk in line with the frameworks of the COSO and auditing standards. The legal and financial implications. Data breaches can lead to various legal and financial consequences, including lawsuits from shareholders and regulatory fines. Companies such Companies must carefully consider their legal obligation and potential liabilities in disclosing such events and assessing the need for the loss contingencies. Transparency and disclosure. Being transparent and accurate disclosures of material events, risk, uncertainty is essential for maintaining investors' trust and confidence. Companies must adhere to the regulatory requirements and best practices in disclosing information relevant to investors' investment decisions. Ongoing concern assessment. Both management and auditors play roles in evaluating a company's ability to continue as a going concern. Assessing the company's financial health, prospects, and potential risk is crucial for providing investors with a realistic view of its future viability. So overall, the case underscores the complex interplay between cybersecurity, financial reporting, risk management, and corporate governance. It emphasizes the importance to proactive risk management, transparent communication, and robust internal controls in navigating and mitigating the impact of cybersecurity incidents on business operations and financial performance. Thank you so much for your time. On my last slide, I included my references, and I hope you've enjoyed this presentation. Have a great day.